Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamlin, principal broker at Real Approved Incorporated and a certified 10X business coach. In today's episode, we've got some exciting updates on the Greater Toronto Area real estate market. Let's dive right in. Spooky season has even Toronto's struggling real estate market coming back from the dead, with sales on an upward swing for the first time in many months and buyers bidding up selling prices in more neighborhoods. Based on stats from the Toronto Regional Real Estate Board's newest report, last month marked both a month-over-month and year-over-year spike in the number of homes changing hands after a lengthy lull that had stakeholders seriously concerned. Another firm, Wahi, has just released new figures on bidding wars, which are also heating back up in parts of the Greater Toronto Area, flipping the switch on what had become a trend of prospective homeowners underbidding on properties. Wahi surveyed the market and pinpointed which districts in and around Toronto are seeing buyers offer less, at, or more than the asking price. While only 13% of the region's communities are now in overbidding territory, this marks a 4% increase from the month prior. A larger 28% of homes across the region went for more than their listed price. On the flip side, the proportion of areas considered to be in underbidding territory has dropped slightly from a staggering 89% in August to 86% in September, and 69% of homes went for under that mark, down 1% from August. Though these are very minor changes in either direction, they signal a reverse of the trend we saw over the summer. Wahi adds that the fall market is generally when things pick up, and that we are still seeing transaction levels and bidding activity well below last year's levels for this time of year. In September 2023, 24% of Greater Toronto Area locales were in overbidding territory, with an additional 3% selling at asking. This is a far cry from the 13% and 1% respectively last month. The pockets that were most overbid include St. Clair West in Toronto, by an average of $103,065, Raymerville and Markham by an average of $100,000, the Danforth in Toronto by an average of $90,550, Wexford in Scarborough by an average of $81,000, and the Junction in Toronto by an average of $78,500. Based on this data, these areas could be regarded as places where the market is heating up and properties are becoming ever so slightly more in demand. As far as the most underbid neighborhoods, per Wahi's numbers, we have Toronto's Forest Hill by an average of $199,000, North York's York Mills by an average of $162,000, Oakville's Old Oakville by an average of $145,000, Toronto's Lawrence Park by an average of $113,000, and Mississauga's Port Credit by an average of $106,300. Though buyers looking in these corners of the Greater Toronto Area may get a better deal as far as being able to snag a place below its listing price, these are all notoriously expensive areas with far higher prices than those on the overbidding list. Realtors may argue the rebound they were hoping for is on the way with lower interest rates, but it's hard to know based on just 1 month of this upward trajectory. Jason Mercer, the chief market analyst at the Toronto Regional Real Estate Board, recently shared some insights with Financial Post's Larissa Harrapin about the current state of the housing market. Mercer pointed out that although there is more choice available for homebuyers, many are still waiting for further interest rate cuts from the Bank of Canada before making a move. According to Mercer, the anticipation of lower interest rates is causing a bit of a standstill in the market. Buyers are hesitant to commit because they expect that better financing conditions could be just around the corner. This wait-and-see approach is contributing to a slower market despite the increased inventory. Mercer also noted that the Bank of Canada's recent decisions have already had an impact on the market. While some buyers are jumping in now, hoping to secure properties before any potential rate cuts, others are holding off, creating a mixed landscape. The increased inventory is giving buyers more options, but it's also leading to longer listing times for sellers. Sellers are finding it challenging to attract offers at their desired price points, which is creating a more competitive environment. The market dynamics are shifting, and everyone is watching the Bank of Canada closely for their next move. Mercer highlighted that this period of uncertainty is not unusual. Historically, The real estate market often experiences fluctuations based on anticipated changes in interest rates. What we're seeing now is a typical cycle where buyers and sellers adjust their strategies based on economic forecasts. So, what does this mean for you if you're looking to buy or sell in the Greater Toronto Area? For buyers, it might be worth considering the current market conditions and the potential benefits of locking in a mortgage rate now, rather than waiting. For sellers, understanding that buyers are cautious could help in setting more realistic price expectations and possibly even reevaluating marketing strategies. High interest rates have been a significant challenge for the housing and development industry over the past few years, and now we have concrete data to back this up. According to modeling by the Canada Mortgage and Housing Corporation, higher interest rates in 2023 resulted in about 30,000 fewer housing starts. That's a decline of around 12%, considering the annual average is typically around 250,000 housing starts. Aled Yorworth, the deputy chief economist at CMHC, elaborated on this in a recent commentary. He said, "Our modeling suggests that in 2023, higher interest rates decreased housing starts by about 30,000 units in Canada. This decrease translates to a 10 to 15% decline, underscoring how sensitive the housing market is to interest rate fluctuations." The Bank of Canada's policy interest rate ended 2022 at 4.25%, was raised to 4.50% in January, then to 4.75% in June, and finally to 5% in July. It stayed there for the rest of 2023 until rate cuts began this June. This sequence of rate hikes has had a profound impact on both the buyer and developer sides of the market. For condominium projects, higher interest rates have tempered buyer enthusiasm due to increased financing costs. Developers often need to hit pre-sale targets, usually between 60 and 70%, before they can secure financing to start building. If buyers are hesitant to commit, builders can't move forward with construction. Small investors who provide much of the funding for condo apartments are also affected. Developers raise funds from prospective buyers who may either occupy the units or rent them out. Therefore, the willingness of individual buyers and investors to borrow money dictates the construction of condo buildings. Rental projects are also feeling the pinch. Large investors, who supply much of the financing for multi-story purpose-built rental buildings, face elevated costs themselves. These multi-million-dollar construction costs need to be covered upfront before rental revenues start flowing in. Financial institutions step in to provide debt to match these current costs with future revenues, but this makes construction projects highly sensitive to interest rates. Yorworth pointed out that the sensitivity of private investors, whether large or small, to macroeconomic fluctuations suggests that ensuring a long-term continuous flow of investment funds is essential for increasing housing supply. He stated, "The willingness of individual buyers and investors to borrow will dictate the construction of condo buildings." Although the Bank of Canada has started cutting interest rates after finally hitting their 2% inflation target, the relief isn't immediate. Yorworth noted, "We remain concerned that starts in Toronto have yet to reflect the full impact of higher interest rates." While delayed effects of higher rates will likely continue, the move to lower interest rates should stimulate housing supply over the coming year. Most of the housing supply in Canada comes from the private sector, and Yorworth emphasized the need for government support. Over the past 2 decades, Canada has built a structural deficit in housing supply that can only be remedied through extensive investment by the private sector, he said. With the private sector providing roughly 95% of housing in Canada, this is especially true for addressing the affordability challenges of the middle class, whether for rental or ownership. Governments can support the private sector by reducing approval times, reducing uncertainty, and designing frameworks that ensure construction can continue even when interest rates are high. Yorworth concluded, "Ultimately, building a future where all Canadians have access to housing that is affordable requires a collective effort." While higher interest rates still present a short-term hurdle, they offer important learnings for us all. We must consider ways to empower the private sector throughout the economic cycle if we are to address the housing crisis. The Greater Toronto real estate rut continued last month. Toronto Regional Real Estate Board data shows the price of a typical home fell once again in September. Despite a mild improvement in sales, inventory climbed much faster, applying further downward pressure on prices. The benchmark is now within spitting distance of prices rolling back 3 years. Greater Toronto real estate continues to slide lower. The price of a benchmark or typical home fell 1.2%, which is about $13,500, to $1,068,700 in September. This marks the 5th consecutive monthly drop, rolling back prices to the start of the year. The mini boom in anticipation of falling rates has now almost entirely reversed. Home prices have fallen significantly over the past few years and are close to reaching a new milestone. Home prices are 4.6%, or $51,500, lower than last year and have fallen 18.7%, or $245,100, since peaking in March 2022. Even if price declines slow further, just a quarter of the decline seen last month will roll prices back to September 2021 levels, reversing 3 years of movement. Reversing post-2020 rate cuts is still a long way off. The benchmark would need to drop another 21.8% before prices are back to March 2020 levels. It really emphasizes how frothy this market's been in recent years. There was a minor improvement in one area: home sales. The Toronto Regional Real Estate Board reported annual growth rose 8.5% to 4,996 homes in September. It sounds like a substantial move, but the comparison period was one of the slowest on record last year. Still, some growth is better than no growth. Greater Toronto is seeing a lot more sellers anxious to get out of the market. New inventory climbed even faster than sales to hit 18,089 new listings in September, up 10.5% from last year. The buildup of inventory helped push active listings up 35.5% to 25,261 units over the same period. Toronto inventory went from scarce to a glut as fast as raising rates killed profits for speculators. The surge of inventory has the market deep in bear country. The sales to new listings ratio fell to 28% last month. An SNLR below 40% is considered a seller's market, where the industry generally believes prices will fall. Toronto rarely plunges to this level, and with the flood of inventory and rental vacancies, the odds are stacked against a quick bounce for now. Interest rates are dropping, but many Canadians are still feeling the hangover of the highest lending costs in a generation. For those stuck paying elevated mortgage rates, or who want to cut high-interest consumer debt, breaking a mortgage contract could make sense. But experts say borrowers need to watch out for what could be hefty fees. The draw of refinancing comes as discounted fixed mortgage rates have fallen from around 5.49% last October to rates now being offered at just under 4.00% for the most qualified borrowers, according to RateHub. Securing that 1.5 percentage point drop on a $400,000 mortgage balance would save about $338 per month. Reducing the interest rate on a $10,000 credit card balance from 20% to 4% would, roughly speaking, push monthly interest payments down to $33 from $167. The potential savings come as both the Bank of Canada and the United States Federal Reserve have started lowering rates for the first time in more than 4 years now that inflation has subsided. For those who locked in a rate near the peak, or who have had to add high-interest credit card and other consumer debt to manage through the cost of living crunch, it could pay to secure a lower rate or consolidate debt into a new mortgage, said Leah Zlatkin, a mortgage broker and lowestrates.ca expert. Certainly, there have been people who have acquired extra debt over the last couple of years, and now that rates are coming down, it is an opportunity to refinance, she said. Pay off some of those credit card debts that you are paying out at, 15+% and put that into a mortgage instead. There are many Canadians who have had to turn to credit card debt, as outstanding balances hit $122 billion in the second quarter, according to Equifax, up 13.7% from a year earlier. Balances grew more for those who were also paying a mortgage. The financial strain of higher debt and borrowing costs helped push the delinquency rate for non-mortgage debt up 23% from a year earlier, said the credit reporting agency. But breaking a mortgage is not without its pitfalls. most notably because all the fees that go with it. Some mortgages, including most with a variable rate, have a fairly straightforward penalty of 3 months of interest payments. But it can get more complicated with fixed rates, where the charges can vary considerably by lender. Many fixed-rate mortgages use what is called an interest rate differential to help determine the cost, which will factor in how far along the mortgage is, and as the name suggests, the difference in interest rates from when the mortgage was first secured and when it is being refinanced. It is very nuanced. It really depends on you and your lender, said Zlatkin. Refinancing a mortgage will generally also involve legal fees, an appraisal charge, registration charge, and, if switching lenders, a discharge fee. While the terms should be laid out in the mortgage agreement, Zlatkin recommends talking with a broker as there are numerous variables to factor in, including the timing around when to make the change. If interest rates drop further, as they are expected to, borrowers could face higher penalties on the interest rate spread. But part of what makes now a potentially worthwhile time to consolidate is that fixed rates have already factored in the expected interest rate declines. The current 5-year Canadian bond yield, which helps determine fixed mortgage rates, is already pricing in the Bank of Canada, cutting to 2.5% from its current 4.25%, noted a report by Butyl Goodman Investment Counsel. If the Bank of Canada stops cutting rates at 2.75%, which is in the middle of where the central bank thinks its policy rate will settle, then bond yields and fixed mortgage rates could rise. The potential for changes in the outlook, such as if inflation starts rising again, means it is important to lock in a rate early, said mortgage strategist Robert McLister. The market's expectations can change dramatically, he said. So at least you know, securing a rate now protects you in the event that inflation pops up in the next few months. As an alternative to mortgage refinancing, homeowners could also consider a home equity line of credit to pay down higher interest debt, but McLister said that is better as a short-term option. If it is going to take years to pay off the debt, he said mortgage rates would likely be the better bet. He said that while consolidating high-interest debt into a mortgage can be helpful, he warns those struggling with poor credit, potential job loss, or a falling home value might have trouble refinancing. But consolidating debt at a lower rate should reduce how much needs to be paid each month. That would improve the debt service ratio and should help mortgage qualification, while being able to manage the lower payments could also boost someone's credit rating, said McLister. If you consolidate debt and all of a sudden you are paying off all of this revolving debt, that is a good thing. All right, that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. We have covered some critical updates from the Greater Toronto Area real estate market, including the latest trends in overbidding, the ongoing impact of high interest rates on housing starts, and the complexities of breaking a mortgage for better rates. I hope you found this episode informative and helpful as always. Thank you for tuning in, and we'll catch you in the next episode. Until then, stay informed and make well-informed decisions. I'm your host, Steve Hamoan,